Hey everybody, welcome back to the channel. If you have been here, first of all, thank you for still being subscribed. And if you're new here, hi, I'm glad you found this video. So 6 months, I know a lot of you have messaged me asking if I'm okay, if the channel is dead, if I've given up on investing altogether. And I'm genuinely appreciate every single one of you, those messages. It really means more than what you think. The honest answer is I didn't stop because I lost interest. I actually did the opposite. I went quiet because I was doing a lot of reading, a lot of tracking, a lot of thinking, and I was sitting with my watch list, going through the annual report, understanding businesses more deeply before putting our views out in public. Because here's something that I've learned. It's very easy to make a video. The harder part is that it's very difficult to make a good video. And I just don't want to come back with half-baked information just to fill a content calendar. So I took my time out. I let the ideas marinate. And today, I feel I let the ideas do much more than what it is expected to do. So here I am back with the honest confession as to exactly what I have been doing over the last few days and how I envision this channel to grow from now on. All right, now let's get into it. So today I'm covering 5 stocks that have been researching over the past several months. These are companies across India's infrastructure, electronics, and power manufacturing. We'll look at these fundamental moat, the financial numbers that matter, the technical levels, the promoter holding, and the headwinds and tailwinds for each of these businesses. 5 stocks, 2 slides each. Let's dive in. So, the first stock that we are going to talk today is Polycab India. Now, if you have been following the Indian market for even a little while, you have probably heard this name. But I want you to understand why this company is genuinely interesting. Not just because it's large cap or because everyone talks about it, but because of what it actually does and what makes it hard to compete with. Polycab is India's largest manufacturer of wires and cables. They have a 26 to 27% share in the organized domestic market. And when I say organized, I mean the part of the market that is actually formalized. Because this sector still has a significant unorganized component, and the shift from unorganized to organized players is a long term structural tailwind. Now, what's the moat here? First, scale. They have about 10,000 SKUs, that means over 10,000 product varieties across retail and industrial use. No competitor comes even close to matching that breadth. Second, the distribution. They reach over 2 lakh retail outlets across India. Building that kind of distribution takes decades. You can't replicate it overnight with money. They have also started moving into the FMEG business, that's fans, lights, switches, appliances. The idea is to leverage their existing distribution muscle to sell more products to the same retailers. It's called smart diversification. Now, on the financial side, and that is where it gets good, the ROE is 29.4%, right? Return on equity is 21%. Revenue in 2025 was approximately 22,600 crore. That's 24% growth year on year. Profit after tax grew about 13.5%. And here's the one that I really like, the debt to equity ratio. That's 0.02 times, essentially zero debt. This company is self-funding its growth. Promoter holding looks good at 61.5%, very much comfortable. One thing to watch, it has come down about 5% over the last 3 years, so keep an eye out on whether that trend continues. On the technical side, RSI is around 52, which is neutral territory. The stock is trading near its 50-day moving average, kind of consolidating, and it's well above the 200-day moving average. So the long-term upside is intact. The range has been roughly 55,000 to 6,500 for several months now. A clean breakout above 6,500 with volume would definitely be a good signal for an entry. Now, what's the tailwinds here? India's T&D capex is massive. The government has allocated about 9 lakh crore for power infrastructure over the next 5 years. Every meter of cable in every transmission line, every housing project, every solar plant, Polycap is a direct beneficiary of that. Real estate is also in an upside, which drives demand for housing wires. The headwinds. Copper price volatility is always a risk for this business. When copper prices spikes, margins get squeezed in long short term. Competition from Havels and KEI is intensifying, and the FMEG sector, while promising, hasn't turned meaningfully profitable yet. Overall, this is a steady compounder in a sector that is directly aligned with India's infrastructure story. Not a fast mover, but a reliable one. Next one, Keynes Technology. Now, this is one that I find particularly interesting because it sits in a space that most retail investors don't fully understand: electronics manufacturing services, or EMS. Now, let me break this down simply for you. EMS companies don't make their own products and sell them under their brand. Instead, they manufacture electronics for other companies. They are the factory behind the product. And in India, the space is growing rapidly because we have seen dependent on Chinese importer for electronics for decades. That is now changing, driven by PLI schemes, the China plus one strategy that global companies are pursuing, a rising domestic demand. What makes Keynes completely different from the other EMS player is the complexity. Most EMS companies manufacture simple, high volume consumer electronics. Keynes goes after the hard stuff: aerospace, defense, outer space, nuclear, medical. These segments have very high entry barriers. They require certification and precision that very few companies can provide, and that comes with significantly better margins. They also offer end-to-end services from conceptual designs all the way to lifecycle support, not just assembling a PCB board, but actually being involved from the design stage. That is genuinely differentiated capability. Financial numbers: ROCE 16.4%, ROE 10.3%. Now I know this numbers looks lower compared to the other stocks we'll cover today, but remember, Keynes is still in a high growth phase, investing heavily in capacity. Revenue grew 51% in financial year 25. Profit after tax grew 60%. The net debt is 0.19, which is actually less compared to the other peers. No promoter pledge. Promoter holding is at a 53.5%, but here's a flag: it has come down about 10% over 3 years. That's something we monitor and understand. Where they're selling, where they're doing a secondary offering, context matters here. And that is a homework. I leave it for you guys for Keynes Psychology. Technically, RSI is around 55, mildly bullish. The stock corrected nearly 40% from its high, and it's now in a stabilization phase. It's trading above the 50-day moving average after a recent recovery. The 3800 to 4000 range on the downside is being watched very, very closely. This is a high beta stock. It moves a lot, suitable for investors who can handle that volatility. The tailwinds. The PLI scheme for electronic carries a 41,000 crore incentive pool. India's defense indigestion pushes it higher. And as global MNCs accelerate their China plus one strategy, India becomes a logical destination, and Keynes is one of the best positioned companies to capture that. The risks: promoter stake reduction needs explanation. ROC and ROE are still below what you would ideally want in a quality business, and the valuation is pricing in a lot of future execution. Any slip in growth or margin gets punished quickly by the market. But the long term thesis is intact. India's EMS story is just getting started, and Keynes is one of the best companies which is well positioned in the high value segment. Dixon Technology. All right, number three, Dixon Technology, and this is a fascinating story. Dixon's tagline is the brand behind the brands, and that really captures what they do. They manufacture TV, mobile phones, LED lights, washing machines, IT manufacturing, and many more. But all of it is under other brands. Motorola phones, many of them are made by Dixon. Xiaomi, Oppo, Nokia. Dixon is the manufacturing partner in India. And why is this model powerful? Because you don't take brand risk, you don't spend on advertising, you get long-term manufacturing contract, and as your customers grow, you grow. The risk is concentration. If a major customer leaves, it definitely hurts. The number that jumps off the page in financial year 25 is revenue, approximately 38,860 crore. That is 120% growth year on year, 120%. And that's almost entirely driven by their mobile and EMS division, which went from 43% of revenue in financial year 23 to 84% of revenue in 9 months of financial year 25. The scale up has been extraordinary. ROCE 44.2%, ROE 27.9%. These are genuinely strong capital efficiency numbers. The company has a debt to equity of 0.34%, which is high, but it is also very much within the permissible limits for a EMS high capital intensive business. On 38,000 crore of revenue, you are generating about 15,000 crore of operating profit. The business runs on scale, not on flat margins. That means if volumes ever sleeps, the bottom line feels it quickly. The promoter holding of 28.8%, which is on the lower side, keep that in mind before you make any decision on this particular stock. On the technical side, RSI is near 48, hovering around neutral. The stock has corrected about 6%, 26% from its peak, and it's now consolidating. It's above the 200-day moving average, and the gap is narrow. The 13,000 to 13,500 range is being watched as strong support. For long-term investors, this kind of correction in a fundamentally sound business is often an opportunity, but you need conviction in the story. Tailwinds. Apple is deepening its India footprint significantly. Dixon is reportedly in discussion to be part of that supply chain. In IT hardware, PLI scheme carries 73,025 crore in incentive for laptops and tablets. Dixon is well positioned there. And India's target of $25 billion in mobile exports by 2026 is a national priority, which means the policy environment stays supportive. The risk. Thin margins means operational leverage cuts both ways. Heavy customer concentration is a structural risk, and the promoter holding at below 30% is worth flagging. Ideally, you want promoters more heavily invested alongside you. But Dixon is India's best in class EMS operator at scale. The India manufacturing story is multi decade, and Dixon is right at the center of it. The next company on our list is Apar Industries. Now, this one is a little different from the previous three. This is more traditional industrial company, but one that is sitting at the intersection of some very powerful global themes. Apar is the world's largest manufacturer of conductors. I want to let that sink in. Not India's largest, the world's. Conductors are the cables that carry electricity across transmission lines, the backbone of every power grid. And globally, for grid infrastructure, that right now. India is expanding its grid. The United States is spending heavily on grid modernization through the Inflation Reduction Act. Every renewable energy plant, solar, wind, needs conductors to connect to the grid. APAR has three main segments: conductors at about 48% of revenue, cables 27%, and lubricants 25%. They have also recently added a transformers segment. This diversification is a strength. They are not dependent on any particular single product line. Financially, the ROCE of 32.3%, ROE of 18.2%, revenue in financial year 25 was approximately 18,681 crore, which is 15% growth year on year. Now, PAT was essentially flat, down about half a percent. That's a significant disappointment, and it's largely because raw material cost and working capital pressure ate into those margins, even as the top line grew. This is something to watch for the next financial year. Promoter holding is a healthy 57.8%. Debt to equity about 0.14 times. Modest and manageable. Technically, RSI of around 50 is neutral. The stock has had a remarkable run, up 78.5% in 1 year. After a move like that, some consolidation is natural and healthy. It's above the 200-day moving average comfortably. The 8,000 to 8,500 range is being watched as support to any deeper correction. The tailwinds here are genuinely global in nature. India's T&D capex is 9 lakh crore over 5 years. APAR is a direct play on that. The US Inflation Reduction Act is funneling hundreds of billions into grid infrastructure. APAR has a growing export book on the US market, and the renewable energy transitioning globally is structurally dependent on more and better conductors. The risk: aluminum and copper prices are a constant variable. Any sharp move in metals squeezes margins. The flat pad in financial year 25 is a yellow flag. You want to see margin recovery in the next year. Working capital is also rising, which adds some stress to the balance sheet. APAR is a kind of stock where the macro tailwinds is undeniable. The question is always execution and margin management. If they are right, their earnings growth should follow the same revenue growth. Next company in the list is Silchar Technology. This is a Vadodara-based transformer manufacturer. Established in 1986, listed on BSE for years, and only recently got NSE listing in November 25. Small cap. Not many people talk about it, but the numbers are extraordinary. ROCE 71.1%, ROE 52.8%. Revenue grew from about 280 crore in financial year 23 to 623 crore in financial year 25. That's 107% growth in the last 2 years. PAT was 147 crore. The company is almost debt free with cash on the balance sheet. Promoter holding 62.1%. Now, what does Silchar actually do? They make specialized, high efficiency custom transformers, not the mass produced commodity kind, the kind that goes into renewable energy plants, telecom infrastructure, industrial facilities, and export to international markets. They also make electronics and telecom transformers. The key differentiator is customization and quality. Their customers aren't buying the cheapest transformer, they are buying a precise, reliable one that meets specific technical requirements. That gives Silchar pricing power that a commodity manufacturing simply doesn't have. Technically, and I will be very transparent here, this one has corrected significantly. RSI is around 45. The stock hit an all-time high of about 6,125 rupee, which has come back to 3,900 levels. That's roughly a 35% correction. And it's now testing the 200-day moving average, which is a key support zone. For a stock that has corrected this much, you are essentially looking at a mean reversion opportunity, but only if you believe in fundamental story is intact. The tailwind are compelling. Globally, there is a transformer shortage. Order book across the industry are full and pricing power is improving. The solar and wind energy build-out requires specialized high-voltage transformers. Silchar's sweet spot, the data center boom, is also a growing customer segment for telecom and high-frequency transformers. The risks are real too. This is a small cap. Liquidity can dry up quickly and the stock moves sharply in both directions. The revenue base, while growing fast, is still relatively small. Any large order getting delayed can impact quarterly numbers meaningfully. And the NSE listing is very recent. So institutional coverage and research is still thin. That one is not for everyone. But if you're looking at patient investors who does their homework and is comfortable with small cap volatility, Silchar is very interesting business at a price that has come down meaningfully from its highs. All right. So that was all five stocks: Polycap, Keynes, Dixon, Apar, and Silchar. To quickly summarize the themes at play here: infrastructure build out, electronics manufacturing in India, the global energy transition, and specialized industrial manufacturing. These are not short term trades, these are businesses tied to multi year structural stories that I believe are just in the early to middle innings. I will put the slide I use in this video in the description below so you can go through the numbers at your own pace. One more time, I want to be very clear. I am not a SEBI registered investment advisor. This is my personal research shared for educational purposes only. Please consult a qualified financial advisor and do your own due diligence before making any investment decisions. Markets carry risk. Past performance doesn't guarantee future results. If you found this video useful, please hit the like button. It genuinely helps this channel, and if you want more content like this, subscribe and turn on your notification so you don't miss out on the next one. I am planning to be much more consistent from now on. Drop a comment now. Tell me which of these five stocks you are most interested in. I would love to know what the community is thinking. Thank you all for watching. See you in the next one. Bye bye.